So, looking at the economic calendar, as you all know, we had Monday today. It was expansive, partially due to the fact that we had news. So, I think I've said this before, but whenever you have news on Monday and there's no news on Tuesday, typically Monday will expand and Tuesday will be generally a little bit more lackluster, difficult to navigate. Now, that's not to say there will be absolutely nothing to do at all, but just don't come in with as high of expectations. So, Wednesday, same thing. Be a little bit cautious. Don't hold too high of expectations. Thursday, 8:30 a.m. news. So, Thursday will likely be a good trading day. Friday, 8:30 a.m. news. Friday will likely be a good trading day as well. And we could see that 8:30 a.m. I think I've said this before, with some news events being smoke screens. Every news event is a smoke screen, but some of them look innocent when they're not. Core PC price index is one of those news events that 8:30 can just pose a CPI or a non-farm payroll event. So we'll see if we'll get that this week. So if a sequential SMT or a setup forms and we have narrative in tune before 8:30 a.m., then we could see 8:30 act as a pretty large distribution on Friday. But looking for which days are likely to be the higher low of the week, coming in with what you've learned now with weekly halving theory, we would split right here. So Monday, Tuesday, and Wednesday, this would be characterized as the first half. And then Thursday and Friday, this would be the second half. So we want to see the higher low of the week form Monday, Tuesday, or Wednesday. And then we could see, let's say, the high of the week forms Monday, Tuesday, or Wednesday. Then we could see Thursday or Friday form the low of the week. And then vice versa. If Monday is low of the week, then we could see Thursday or Friday form the high of the week. So now looking at the chart, as you guys know, we wanted to see these highs get blown through, which they did. And in that pre-recorded lecture, I stated that it could run down there one more time and then head higher, or it'll just completely blow through the highs. And it chose to just completely gap up and then blow through the highs. But regardless, we still got these highs met. So now going to the weekly time frame, having the S&P on the left, the NASDAQ in the middle, and the Dow on the right. So as far as where we can expect price to draw to next, I'm monitoring if we can trade inside of this low that's in tune with this weekly time frame fair value gap on the S&P. So this is more so a key level or draw on liquidity. And if it hits, we will see or do a review on specifically why I chose this low, because this is something that you see pretty frequently once you understand what it is. But I would like to see price dig a little bit deeper inside of this weekly time frame fair value gap. And on the Dow, I would like to see the Dow trade inside of the gap as well. So as you can see, the S&P and the NASDAQ have already traded above this high, trading into this weekly time frame fair value gap, while the Dow has not. I view this as a SMT market structure shift. So I would like to see higher prices for now and for the Dow to catch up and then take this high. But looking a little bit closer, going now to the 4-hour time frame, an objective or a draw on liquidity that we have along the way for that higher time frame level that we had marked, which would have been this right here. As we can see, we have a liquidity pool resting slightly below it. So for now, this is my draw on liquidity. And then depending on how we trade above this high, if we're able to reach above there, depending on how we treat this, if we close above it and expand above it, then I'll expect these highs to be drawn to next. But if we form a cracking correlation, then I would expect lower. and a return into the range. Same thing for the NASDAQ. For now, this is my draw on liquidity. And then for the Dow, this is the draw on liquidity. But now looking at today's price action. So one thing to keep in mind is whenever we have a large range, especially in the Asia and the London session, and we see price expanding aggressively, I'm not expecting a daily cycle SMT to form. I'm not expecting price to drop all the way back down below these lows and then a rally higher. Typically, whenever you see a large range form in Asia or London session, or both, that's whenever 90-minute cycle sequential SMTs are usable. So knowing that, if you would have came into today as we can see, right at 9:30, and hopefully nobody forgot the basics, because as we know, 9:30, that is a volatility injection in and of itself. 9:30 creates a daily cycle, not a daily cycle, a 90-minute cycle sequential SMT. So the S&P runs below this low, while the NASDAQ fails to run below this low, creating a failure swing. And then what do we have right here? Yes, the TPD. Now looking at this, which asset is stronger? Without me having to point you in the right direction. Yes, the S&P. Why is the S&P stronger? Yes, because candle 3 made a higher open to candle 1's close, while on the NASDAQ, candle 3 made a lower open to candle 1's close. Now, what indicates that this is bullish? You have the sequential SMT. Whenever narrative is a little bit iffy in times like this, because we had already met our draw on liquidity and Monday acted as a continuation, whenever times are a little bit iffy, having a sequential SMT to kind of back you up is very, very useful. So if you have a TPD that forms on a lower time frame or a lower cycle, and there's a lower cycle cracking correlation as well, that's typically where the higher low of the session will be. But with that information of knowing that the S&P is stronger, what is the NASDAQ likely to do? Yes, run below the low of candle 2. So going from a 5-minute time frame to a 1-minute time frame, we can see this is the TPD right here, just viewing it through the lens of the 1-minute time frame. Viewing the S&P, what do we have? Whenever this candle closes, specifically in the second half of candle number 2, as soon as this candle closes, what is that? Exactly, the change in the state of delivery. So then what would this be? This wick. Exactly, the reversion level. Candle 3 opens up, runs down, tags inside of that reversion level, and then rally higher. What does the NASDAQ do whenever candle 3 on the S&P is dropping lower, tagging into the reversion level? What is the NASDAQ doing? Exactly, running below the low of candle 2, which you can see right here. So this is still a sequential SMT, even though it has no regards to quarters. This still is sequential. So we have a two-stage sequential SMT. After price tags that reversion level and runs higher, candle number 1, and this is where we drop a little bit of sauce. Firstly, what would this be characterized as? The first phase accumulation. Now, coincidentally, that first phase accumulation is what? Candle number 1. So, whenever you drop down to the lower time frame, and especially if that first phase accumulation and the TPD are close together, sometimes you won't see a fair value gap get dropped into after it breaks that first phase accumulation, and it'll form on the original consolidation. So this entire range would be the original consolidation right here. This would be that first phase accumulation. This is the reversal. Price breaks higher. After it breaks above this high right here, what does it do? After it breaks higher, price forms a fair value gap, tags inside of that fair value gap, rally higher. So whenever you spot exactly what I've taught you, what are you trying to enter on? And where are you trying to put your stop loss? Because I see a lot of you talk about you're kind of unsure where to place your stop, or you're unsure where to enter, or where to enter at. The highest echelon of entry will be number 1, the reversion level. So that's number 1. Number 2 is the fair value gap that forms after price breaks above either the first phase accumulation or the original consolidation, depending on the circumstances. So those are your two, you have 2 opportunities to get alongside a run. Sometimes 3 if you're lucky. Who remembers when I said that? Anyways, those are your 2 areas of opportunity where you want to enter. Where are you placing your stop loss? For the reversion level, if you are a little bit more conservative, you can have your stop right here. So this will be your entry, this will be your stop, and then you're targeting either a 1 to 3 or a 1 to 2. Now, where are you taking partials at? You could take a partial right here. You could take a partial right here, which I wouldn't really recommend since that's so early on in the price run. Or yes, like what somebody said, you could take it above the 50%. But whenever it comes to taking partials, if you were to take a partial right here, you wouldn't want to close more than, I would say, don't take off more than 30% of the position or 25% of the position. Because if you take off, whenever price doesn't breach from your full target or your full risk to reward to your entry, if you take half of your position off, exactly at half from your target to your entry, and it still reaches your target, that would be the exact same as taking it off in full halfway through. So whenever you take partials, don't cut half. Only cut about 20% or 30% of the position, and then let your trade run. So as far as stop loss goes, if you're a little bit more conservative, you would place it below the lowest point, in a bullish example, the lowest point of the reversion level. If you're a little bit more aggressive, you can take that entire reversion level candle and if you get really good at depicting which asset is stronger, you can set your stop either at the half or at the lower quadrant if you have a lot of trust in that reversion level or a higher risk or reward. as far as the fair value gap goes, if you miss the reversion level, which is the highest echelon of entry, and also why am I talking about the S&P in specific? Because this is the one that you would have wanted to trade because it is stronger. But second entry would have been the fair value gap. If you get an entry on the fair value gap, a safe stop loss is, and this is just basic ICT, but a fair value gap has a 3 candle formation. So you have candle 1, candle 2 being the actual gap, and then candle 3 being the one that closes, creating the gap. Under candle 1's low if you're bullish, and above candle 1's high if you're bearish, for safe stop loss placement in a gap. And you can still target a 1 to 3, which I believe got hit a little bit later on. But it still offered a clean 1 to 2. Now let's say you accidentally traded the NASDAQ and then you got wick below. In this example, it would have been, if you would have followed the rules, then you wouldn't have even touched the NASDAQ. But let's say you made a mistake, you accidentally traded the NASDAQ, you had your stop loss directly under this low, and then you got wicked out by a little bit. If you choose the wrong asset, and price creates an SMT like this, which you guys already know, the SMT right here, so the weaker asset creates that SMT on candle 2, on candle 3. If a fair value gap forms after that SMT, and it was just, this run lower was just to create that Kraken correlation, if a fair value gap forms, the same way you use this fair value gap, you can look at that fair value gap for the weaker asset. And as you can see, price still offered a nice 1 to 2. If you would have held a little bit longer. What about the soup for entry? It depends on how confident you are. But if you, there's different ways, and I haven't really spoke about this yet, but that is a way to go about it. If you identify which asset is weaker, you can trade the turtle soup and then get an insane entry like this. But we can go ahead and get to some Q&A. Is there an algorithmic relationship between the final low TPD candle or high to final low in standard deviation to the end of the price run without considering key levels as the target? Yes. And for those that have been around the block, you guys already know what this is. But don't worry. This isn't my discovery right here, and we'll talk about this a little bit later on. But this is the silver bullet zone. And typically you'll see that second entry form within there. Are 30-minute TPDs important or not? They can be used, but just focus on the main things, because the more you add, and I've said this a lot, but the more you add into the equation, the lower probability things become, and the more you think you're seeing something that's there when it's not really there. How do we determine where the new contract opening gap is? Do we just look at the contract switch date on the continuous chart and draw a gap from the close of the last daily candle of that previous contract to the open, or the first daily candle to the new contract? This would be the new contract opening gap. It would be from this candle's close before the switch to this candle's open. Why one should have expected higher prices on last Friday despite the weekly bearish SMT? You just reviewed the day. Well, what has the narrative been? Even since Wednesday's live stream. Since this day, what have we been wanting to see? Exactly. So whenever you're expecting higher prices, all rundowns or any rundown serves as a retracement. And then vice versa. Each day, how do we determine whether Forex or indices is highest probability market to trade? Generally, indices is a lot easier to maneuver, but Forex can be pretty volatile intraday, and it all comes down to really knowing where price is and its footings. Like right now, for euro and pound, we've been expecting this. Now, can you still find small setups in there? Yes. But as far as knowing which one is higher probability to trade intraday, it's all going to come down to what's being presented that week. So let's say there's a weekly bullish sequential SMT and a TPD confirming it in the Forex triad between Monday and Tuesday. And then Wednesday opens up. We can expect Wednesday to continue in that same direction and be a little bit higher probability. And let's say the futures triad is offering absolutely nothing. Then we can get a good guess and say, okay, the Forex triad is likely going to be a little bit higher probability for day trading. So it all comes down to knowing what information is being present for each triad. Could tomorrow possibly return back into the new week opening gap or new day opening gap? From this run here, I would not like to see price drop all the way back in here. If anything, I would like to see this for now serve as a breakaway new week opening gap. Do you see the recent 6-hour TPD for, I believe you're talking about this. So if anything, I would like to see this serve as a continuation TPD. The reason being is number one, drop down to the 1 hour. We can see within here. Is there any change in the state of delivery right here? Can include this candle. No, there's not. While this is a huge accumulation right here, or a huge original consolidation, There's no change in the state delivery. There's no reversion level. There's no SMT governing this. I wouldn't like to see this cause price to reverse. TBD formed at 9:30 is of high probability. There was a 5-minute TBD at 9:55. Yes, TBDs at 9:30 are a lot higher probability. How could you have expected in advance that the Forex would be lackluster on higher time frame? If I would have known, I wouldn't have even traded Forex. Observing this portion of price action right here on the dollar and the S&P. What do we see the dollar and the S&P doing? We can see they're moving in the same direction. Is the dollar and the S&P supposed to do that? Exactly. So one of these is going to consolidate. Once the run is complete, one of these is going to consolidate while the other, quote unquote, plays catch up. Which one did we want to see play catch up? The futures triad, exactly. So that's why the Forex triad has been very lackluster recently. And the reason why in specific that I wanted to see the future triad be the one that plays catch up is because it's not every day you see a 10% correction. Higher time frame. For now, I'm looking. I want us to dig a little bit deeper inside of this fair value gap. But yes, after the resync, it'll become a lot clearer. I believe you're talking about this. I still don't see this as very high probability. Due to the fact there's no clear cut or well defined original consolidation. If it would be here. And even here. As we can see, what is this? So if anything that may cause concern for price going down, I'd like to see that serve as a retracement. Can we use change in the state of delivery to anticipate a reversal or continuation TBD? Yes. Will you do a video on the silver bullet zone? Yes, once we bring standard deviations into the equation. is it okay to take trades this way? So, no. If you have a 15-minute TPD, and you want to see a 5-minute reversion level, and so on and so forth, you're dropping one time frame lower. And then that's where you'll see your entry and you're changing the state of delivery and all of that good matter. But with that being said, we're going to go ahead and wrap this one up. So hopefully you all found this one insightful. I will speak with you all again in tomorrow's pre-recorded lecture. Good luck and good trading.